Well, hey everybody. It's not Don this time. It's Jonathan. For those of you who don't know me, I'm the Director of Research at Mirador and co-portfolio manager of the MAGS strategy. Don asked me to come on today and talk with you guys about what we're seeing in the markets and our thoughts and whatnot. It's my first time doing an Instagram live, and I'm talking to an image of myself, which is kind of weird. So if I seem a little bit nervous, please understand. I was thinking about what I could talk about today that would be meaningful for you guys, given that I spend most of my time at Mirador looking at the data, looking at the markets and the economics. How can I best relay that to you? In the previous videos, Don had shared how you should be thinking about investing in this current crisis environment, and what your bias should be. I think what would be helpful is if in this video I share more of what we are seeing in investing, from the active manager's role. What are we seeing in the markets, and how does that affect our expectations for capital markets over the next 12 months, over the next 18 months, okay? Because that really does affect how we are managing the strategies and what we're doing and whatnot. So this video might be a little long, and I apologize. If it's too long for you, you can just drop off. But there's three things I want to talk about today. The first one is I want to rewind and talk about the conditions that really got us to where we are today. Because I get the question a lot, which is, hey John, is this recession because of the coronavirus? Well, yes, the coronavirus is something that magnified the recent pullback we saw, but a lot of these conditions and the economy and the fragile parts of the economy itself were building up over the past year. Okay, since 2019, if you followed along with our letters and videos, we've been talking about the cracks that were happening, and it's going to be really important to understand what those are, because where we are today, those things still exist, and they will affect how we see the economy moving forward. Okay. The second thing I want to talk about is the coronavirus itself and our response to it as an individual, as a business, as a company, as a nation. Now, I'm a little hesitant to do so. I'm not in the right place to be judging our response as a country, as a state. We're doing a good job. We're taking the right steps. But that is the big story today. And if you look out over the next 6 to 12 months, that is going to be the primary story that drives investor sentiment. Okay, so to really have a game plan as to how we want to invest over the next 12 months, we have to have a clear thesis as to what the possible paths can be from here out. What is the probability of those paths happening, and managing our risk around that. Okay, so I'll share our thoughts about the coronavirus and how that is impacting how we see investments. Second to last thing I want to talk about is what conditions we are waiting for to become net buyers into the market again. Okay, so since Q4, our strategies have already been very defensively positioned, and as of right now, they are the most defensively positioned, I would say, as they've ever been. Okay, so although we are purchasing selectively on the margins when we see extreme value, like all active managers are, we are still primarily holding our dry powder and waiting for the right conditions to show up before we dive in, to equity markets again and just start buying hand over fist. So I'll talk about what some of those conditions we're looking for are. And finally, I'll share with you some of the sectors or companies or whatnot that we're looking at for the next business cycle once this passes. Sorry to break your doom and gloom, but this won't go on forever. If we look at any major pandemic in history, if we look at the Spanish flu in 1918, okay, that killed 1 million people across the world. And if you study it, it sort of followed the same path as we are today, which is, it was a novel virus. People didn't know what it was. They thought it was the flu. When they realized it wasn't, we started doing social distancing at the state and city level, which helped flatten the curve. Fast forward today, we're fine, right? So eventually this will end. Capitalism works. There will be therapeutics. There will be a vaccine. So we need to be preparing for the future and what's next, okay? So let's talk about the conditions that got us to where we are today, okay? First of all, from a high level, the business cycle was already beginning to turn, okay? And we saw many indicators of this. One of them being corporations were investing less into capital expenditures. That's typically a lagging sort of indicator. Typically, you'll see a company pull back on its investments in people and infrastructure and assets, and you won't see that have an effect on growth until the next year, right? But we were already seeing corporations stop investing even when they received their tax benefits from the tax cut. They didn't take that money to hire more people and buy more assets. They instead took that money to buy back their own stock, which indicated to us that these companies didn't see enough growth opportunities out there to put capital to work. Okay, that's one. Also, we were already going through an earnings recession. Okay, although earnings look like they beat every quarter, if you factor out the stock buyback, massive amounts of stock buyback that corporations did, earnings contracted 3 out of the last 4 quarters in 2019. Okay, so companies were just making less money, and that's because there were less opportunities, margins were getting tight, and unemployment was at an all-time low. Business surveys were showing that the number one problem for companies was the Hey, am I there? Okay. So number one problem was their inability to find qualified individuals. And although at the high level unemployment was coming down, 3.7, 3.6, 3.5, 3.5, when we looked at the data, we were actually seeing clear signals that unemployment was rising. If you looked at it at the state level, at the sector level, or by age, or by race, or even by education level, in the highly cyclical regions and the areas, they were starting to come up. Okay, so already this business cycle was turning, and really the coronavirus just expedited what was going on. The last part of the conditions we are today is the over leverage in the corporate system. Okay, am I back? Okay, over leverage in the corporate system. So companies today are on average more levered with debt than they have ever been, even compared to 2008, even compared to 2001, okay? And the large majority, over 50% of that debt in investment grade world is rated BBB, okay, which is the lowest tranche in investment grade before junk grade, okay? And why is that important? It's because based off of simple leverage metrics, a lot of these bonds would actually be rated junk. Okay, so a lot of these companies are already too levered, but they're not. It's because their coverage ratios are high enough. Because we've been through a 12-year bull market, rating agencies have said, okay, it's okay if you're carrying a lot of debt on your books because you have enough cash flow to pay it off. Okay, so that's okay, but it's a problem when things don't go right? I can have $1 million mortgage on my home and pay it off fine if I can cover the monthly mortgage. But it's a problem when I lose my job. Okay, things are going to crash down. So that's a big thing we're seeing, and it's a big risk. I wouldn't just say it's the rating agencies too, it's probably the companies themselves too. When I first started getting into banking, to get debt from a bank, you kind of looked off of a EBITDA metric. They looked off of a debt to EBITDA metric. Over the past few years, I've been starting to hear terms like cash EBITDA, okay? So these companies are creating their own metrics to blow up their EBITDA numbers to raise even higher amounts of debt. So this is not a good thing. It's a heavy reliance on growth, and now that growth has come to a standstill, we're looking at what some people are calling a BBB debt mountain, which could be disastrous for the markets, okay? So now that we know what the past was, where we are today, main story is the coronavirus, and what is our view of that and how that affects investing into the future. What deeply concerns me with what's going on with the coronavirus today is the asynchronous response we are seeing in our country. Okay, so initially, we had talked about the coronavirus through emails and investment committees in February already. And we're talking about how what would happen if this would hit U.S. soil and start community spread here. Well, our government would take draconian measures, like the ones in China. The nation was shut down very quickly, but temporarily, because it would curb the spread and we would start getting back to work. Now, unfortunately, that's not what we've seen. The response we've seen has been state by state, city by city, and company by company. Now, the problem, we're doing a good job, and I promise this will translate into what it means for investments, okay? The problem with that approach is that in a public health crisis, your health depends on my actions, almost even more than they depend on your own actions, okay? So as long as we see beaches in Miami filled with spring breakers from across the country, we are not going to be able to contain the spread of coronavirus in the Bay Area. Okay, so what that will result in is early adopters of shelter-in-place orders and shutting down of economies to be shut down for an elongated period of time, longer than they would need to be to make up for the areas that aren't doing this. Okay, so what does that mean for investments? That means that every day, and this is my perspective, every day that we do not do a nationwide uniform sort of shutdown policy is weeks of unemployment and weeks of business closures on the back end, okay? So the risk of the approach we are taking today as a nation is that every day we don't do anything, it increases the probability that we will see tail risk and that we will elongate the recession and deepen the severity of what's going to happen, okay? So in fact, if tomorrow the entire nation shut down, no companies can turn on their computer, everybody has to stay at home, that would in fact turn me rather bullish on the economy and maybe even into a net buyer, because the halt would be temporary, but it would be fast and we would have a predictable path out. Right now, because of this rolling approach, the predictability is not there, which is a big risk, okay? So then in that case, if our response is not what would turn us into net buyers at the moment, what are the conditions that would be necessary for us to be net buyers? Okay, I will tell you right now, we're not looking at the traditional metrics we typically look at when evaluating stocks, which is earnings, cash flow, margins, and things like that. I think those sort of go out the door. Valuations go out the door. Some investors are starting to come out and say that companies that have come down 30% that are in great sectors, the valuations look good and the prices are great. Long-term investors can make money at these levels. The only problem with that is that just because something is cheap, it doesn't mean it can't get cheaper. Okay, and where we stand today, we have a rather high conviction that things will get cheaper over the next 3 to 6 months. Okay, and that's because the situation we're in today is different than the one we were in Q4, okay? When the market is going up, things have to go wrong for asset prices to drop. You have to miss your earnings, you have to fail for people to want to sell and get out, okay? In the situation we're in today, it's flipped. Things have to go right for us to meet expectations. The risk is to the downside. And let me name a couple of the risks that we're seeing. The first risk is the resilience of large corporations when it comes to earnings time. Okay, a lot of the valuations in high-flying SaaS stocks or large companies are still rather high. They haven't come down very far. And that's because investors are still rather bullish psychologically, and they're hoping that these companies can ride out the storm. What we envision for Q1 is more that there will be positive surprises here and there that seem rather random, but overall, the earnings season will be rather disappointing. And you're going to see most importantly CEOs come out and refuse to give full year guidance moving forward because they themselves don't have clarity over what's going to happen. So I would even venture off to say that not having visibility into the future is worse than even projecting a downward, right? It's worse to not know where you're going than to know you're going in the wrong direction, for example. So the risk of that is to the downside. The second is the effectiveness of the recent $2 trillion stimulus package or relief package and the $350 billion of that which is going to small businesses, and checks should be going out the door today. So this stimulus is actually very meaningful if you look at the numbers, but the risk is in the speed of implementation and the availability and the capacity that banks at the local level have to do this implementation. For example, Steve Mnuchin, Treasury Secretary Steve Mnuchin, was on TV yesterday saying that checks will get mailed out today. This will work. Well, already we're seeing articles on Bloomberg saying that many small businesses cannot get checks today. Many large banks don't even have the applications ready. This probably won't be ready until next week. So the risks of this not working are to the downside. Okay. The third one we're looking at is progress towards flattening the curve, which is huge for investor sentiment, right? When we can curb the spread of this virus, it will turn people more bullish. The problem with that is what I just described, which is we have a lack of uniformity across regions, across states, which will elongate this process. Now, we will flatten the curve eventually. States are taking the right steps, but it will take longer than it should. Okay, so the risk is to the downside. Now, the last one is availability of therapeutics and a vaccine. Now, I'm not an expert in this field, and I won't try to be, but we do see reports that a vaccine or any successful therapeutics would take 12 to 18 months at best, which means that the risk is to the downside of that. Instead, it takes 18 to 24 months. So we're seeing all these risks to the downside, which is making us want to hold our dry powder for now and wait for these two conditions that we see. The first condition is investor capitulation. Okay, aside from flattening the curve, which would be nice. Okay, the first thing we want to see is investor capitulation, which is something we saw in the bond markets a couple weeks ago, but we haven't seen yet in the equity markets. So by capitulation, I mean there are some quantitative factors we're going to be looking at. Okay, we'll be looking at things like fund flows. Okay, we'll be looking at things like dealer spreads, volatility. There's also sentiment, investor sentiment surveys out there. And even you can ask yourself today, how do you feel about the stock market? Are you asking yourself, is now the right time to buy or sell? If that's the question you're asking yourself, then we haven't reached capitulation yet. We will reach capitulation, when you wake up one morning and the only thing you want to do is call your advisor and tell them to sell everything they have. Okay, the day you feel that, that's capitulation, and that's when we will turn into net buyers. Okay, because that's when people will be selling at whatever price, they don't care, and valuations will reach, dirty bargain levels. So capitulation is one sign we're waiting for. The second sign we're going to be waiting for is what I said earlier, visibility, specifically CEO visibility. Now, I'm going to do this. I'm going to do this analysis where I look at in Q2, Q3, and Q4 of last year, how many companies in the Russell 1000 gave out forward guidance, whether it was fiscal year or next quarter. And I'm going to compare that against the number of companies that will give out fiscal year guidance or quarterly guidance this earnings season. And I expect we're going to see a significant pullback in the number that do. I don't think CEOs are going to be willing to give a projection of their forward numbers. So what we are going to be looking for is for those projections to come back. Now, I don't know that that might take 2 quarters or 4 quarters, but eventually that will happen. Now, I'm not necessarily waiting for CEOs to come back with good projections or projections of growth. By that time, it would be too late. What we're waiting for is them to have any projection whatsoever. Because the second the person who knows their business the most knows what is ahead, even if it's bad, that means they have the visibility to do what they need to do to change that scenario. Okay, so capitulation and visibility are 2 factors we're going to be heavily looking at to know that investor psychology has come down and we've reached capitulation and that we should be deploying our dry powder. So coming out of this, when we're deploying our dry powder, last bit, I promise I'm getting to the end. Last bit I want to talk about is when we start deploying the dry powder, what sectors are we looking at, right? There's so much doom and gloom here. Everybody's only thinking about selling when there is opportunity ahead. So first of all, I would like to say that I think this past month has really gone to show, done well in showing the difference between an active management style and a passive management style, right? If you had your money managed in an ETF like SPY, well, you came down a straight 25 to 30% over the last month. And I don't want to brag, but with our strategies, we can actively manage. We can choose the companies that we think will survive this crisis and we cannot invest in the ones that we think will suffer, right? And on top of that, we can also manage the allocations. We can add short positions, which we do. We can hold the cash, and it's really helped weather our strategies through this time. So we actually have the dry powder and the opportunity to be buyers, net buyers, when the business cycle turns. And some of the things we're looking for, I'll leave you with two. One is large cap companies that can weaponize their balance sheet. Now, it's almost become a catchphrase to investors to say, only invest in companies with strong balance sheets. Okay, it makes them smart to say that, because nobody ever looks at the balance sheet. So for somebody to say, oh, you can only invest in a smart balance sheet, makes it look like they look at the balance sheet and they understand it. Most people don't understand a balance sheet, okay? So for most companies, a healthy balance sheet, the purpose of it is to weather periods of downturns, like the ones we are going into right now. When sales disappear, when profitability disappears, they can rely on their cash balance to get them through and pay employees. They can rely on their capital structure to raise debt on favorable terms if they need one. Okay, things like that. There are certain companies out there, though, that have such strong balance sheets that it not only acts as a cushion for them in downtimes, but they can weaponize it. And I'll give you one example. I don't think it's good to talk about companies and try to, it's going to sound like I'm pumping companies. I'm not. And I don't recommend making this purchase or not making this purchase. But one example is Google. Okay, Google is a company, sector that has strong secular growth trends. They have no debt on their balance sheet, so this triple B debt storm that we're looking at has no effect to them. And they have $110 billion sitting in cash on their balance sheet, okay, in their bank account, $110 billion in cash. Let me put that into perspective for you, okay? Over 75% of companies in the S&P 500 have market caps that are less than $100 billion. So Google could go out today with just the cash on its books and purchase almost any company in the S&P 500 it wanted to without having to even take on $1 in debt. And that is just crazy power. You imagine what that means for somebody coming out into the next bull market, and their ability to weaponize that is going to be massive. So that we're making a list of those kind of companies that we like and that we think will thrive through this crisis and out. Another sector we really like and that we're building a list for are enterprise software cloud companies. Software by its nature helps companies become more efficient. Okay, so as we're going through this crisis and as companies are having to pull back on margins, they're going to look for ways to implement software into their systems. And the good thing about enterprise cloud software is that typically once you get in, you don't get out, because it improves your business so much that you just need it moving forward. On top of that, their revenue models, which are recurring by nature, give investors like us who are trying to analyze them really clear roadmap into what their revenues or what their retention cycles are going to look like over the next 12, 24 months. So those businesses are very predictable. Okay, we expect them to do very well in the next cycle, especially because as companies in other verticals are coming out of this crisis, most of them will come out with more debt than they had going in. Okay, an example being Boeing, which is begging the government for a bailout right now. Okay, they will emerge from this crisis with more debt than they had coming in, which means they're going to need to find ways to cut back on expenses, aka implement technology and purchase software that does so. So as they do this, though, we're going to see a strong fallback in the legacy providers, like people who sell on-premise software. I mean, we're already seeing that shift from on-premise to cloud, but I think we're going to see that expedited over the next cycle, because these companies won't have the cash available to make large capital expenditures because they're loaded with debt. So what it means is they're going to have to rely on enterprise cloud software, which is built on an expense model. They pay monthly versus one time, which is going to be huge. It's going to drive people to choose those kind of companies. So those are just two, ideas that we're looking at. We're definitely building our list. I will leave you with this, which is, if you're a client of Mirador, I watch the strategies every day. I watch how they perform and how the market moves, and I'm very proud of how our strategies have been performing. Like I said, we've been defensively positioned since Q4, moving into the crash. For example, in MAGS, I'll have to put a shameless plug because I run MAGS. MAGS was about 30% in cash before the crash in February. Okay, and now that we're down 25% on the S&P 500, not that we've added significantly to that position, that short side, but just because that has risen, we're sitting on approximately, effectively 50% cash in the MAGS position. So what that affords us is great power, just like Google, moving forward into the next cycle. And I will leave you with this one last thing, because I think it's funny. 2 weeks before the crash in February, I read an article written by the CIO of private wealth management for Goldman Sachs. Sorry I have to call them out, but the CIO had said that the market was on a top, yes, but now was the time to deploy the dry capital and get invested, because long-term investors will profit, and that time in the market is the primary thing that drives returns. So don't worry about valuation, don't worry about timing, get in today. It's impossible to predict a recession anyways. A couple days into the pullback, the first day the Dow lost 1,000 points. I saw a news article that says, Susie Orman believes this is the best opportunity for investors and that you should be investing. 1,000-point drop in the Dow, huge value, start deploying capital. And the funny thing with the greater industry and those kind of businesses is that they tell you to invest at the top, and because time in the market is the only thing that matters. And then when things come down, they tell you to invest again because there's great value. But if you listen to them in the first place, you'd never have anything to invest when things came down. You'd be stuck for the next 5 years. Good thing for us and our strategies is that we don't have to follow what they say, and we can make our decisions. We look at the data ourselves, we analyze it, and we come up with theses and paths that we think can go down, and we invest based off of the risks that we see. And luckily, our strategies have been positioned well so that as we are moving through this crisis, although there's going to be a lot of tragedy and a lot of loss of human life, and headlines are going to be bad, and I hope this doesn't personally affect anyone, but I'm sure it will, or your friends or neighbors. The good thing is that in terms of your investments and your financials, at least the ones we manage, if you're a client of ours, we're looking at this period as opportunity, and I think that's going to be a good thing. Okay, that's it. Sorry that went on for so long. Let me see really fast if there are any questions. Okay. I don't see any questions. I did see one earlier. Somebody had asked what I feel about the Raytheon and United Technologies merger that just happened this morning. I wish I could give you a good opinion on that, but I don't. The defense and aerospace industry isn't really my strong suit. I will say, though, that just from a broader level, there are many different ways you can make money in stocks, in special situations, in certain industries and whatnot. And the way I see it, especially with asset-heavy industries and industries that require taking on a lot of debt to invest in infrastructure to grow, those aren't sectors I'm really hot on, especially going through this crisis. So even though we might be seeing a new industry giant forming in the process in that sector, just the macro level of what's going on there, is not something that drives me to want to deploy capital over there immediately. Instead, I'm looking to sectors like, enterprise cloud software, or large cap companies that can weaponize their balance sheet, 5G super cycles, maybe insurance companies as they come out or something. So, yeah. I got one. Any guidance on expected returns for your fund in 2021, given your comments? Okay. I'll answer this way. First of all, just bluntly, no. We don't know what 2021 will hold. If anything, if risk really does go to the downside, we see tail risk. We may not even have therapeutics and a vaccine by that time, and we may still be in sort of containment and mitigation measures. So nobody knows what will exactly happen in the future. But I will tell you this, and this goes also goes towards why we still hold equity positions even though we see further downside, okay, is that it's not so much what the return of your strategy is or what the return of your portfolio is. You know, it's cool to measure against, you know, other people and stuff, but that's not really what we're trying to do here. What we're really trying to do is manage the risk and the return based off of the scenarios that we see. So let me give you an example, which is if I'm 90% certain that a stock will go down, but I like the company, and my target weighting for that stock is 10% in my portfolio, I'm still going to own 1%. Because I cannot give a 100% guidance as to what that stock will do. There's a 10% chance it could go up. So in that case, I need to manage the risk to own 1% of that stock. I'm not selling out completely. By the same token, if I think there's a 90% chance that the stock will go up, that doesn't mean we're loading all in. You know, our target allocation may be 10%, but we will only have to hold 8 to 9 to manage that level of risk. Okay, so on our expected returns for 2021, it's really tough to say, but I can say that the holdings in our strategies right now, I'm very confident in them. I think they will do well through this crisis, even as prices come down. And when they do, we will look to deploy more when we see those factors come up, when we see capitulation and visibility come back. Yeah, I hope that helps answer that. Okay, that's it for me today. Sorry it was so long. Take care and stay safe, stay at home. Okay, see you next time. Bye.